right before you started listening to this, there's a very good chance you bought a coffee.
Oh, almost certainly.
Mm,
Or, a pastry or something.
right. And you probably just grabbed your cup, tapped your phone against that little plastic terminal, heard that satisfying chime, and walked away.
Yeah, it's completely mundane. We do it every day.
Exactly. You didn't even think twice about it. But under the glass of that phone screen, driving that seemingly simple transaction, there's this massive hidden architecture.
Yeah, an architecture that is fundamentally different from literally anything humanity has used for the last few thousand years to transfer value. I mean, we are talking about a complete redesign of what money actually is at a structural level.
It is wild. So welcome to today's deep dive. Whether you are, prepping for a fintech meeting, trying to keep up with how aggressively the financial world is evolving, or you are just naturally insanely curious about the hidden systems governing your daily life, you are in the exact right place. Our mission today is highly specific. We are taking a big stack of notes, historical timelines, and technical data to trace a frankly fascinating evolution. We are tracking how a radical, anti-establishment digital experiment launched in 2008 morphed into the totally seamless, boringly reliable payment apps we all use today in 2026. Okay, let's unpack this.
Right. So to understand the payment app sitting on your phone right now, we really have to travel back to the financial wreckage of 2008. We have to look at the exact environment that forged this technology.
Because it wasn't created in a vacuum.
Exactly. In the fall of 2008, the global financial system was melting down, banks were failing, these massive bailouts were being drafted, and public trust in centralized financial institutions was functionally at zero.
Just totally gone. And right in the middle of that chaos, on October 31st, 2008, an anonymous entity using the pseudonym Satoshi Nakamoto hits publish on a white paper.
Yeah, the famous white paper.
Right. The title is Bitcoin, a peer-to-peer electronic cash system. And reading through our sources, this wasn't just a technical blueprint. It was a direct political and economic response to the crisis.
It was a manifesto, really. Satoshi was proposing a system of money completely divorced from state control, central banks, or corporate boards.
And the theory actually moved to reality pretty fast, right? On January 3rd, 2009.
Yep. That is when the Genesis block was mined. This is the absolute first block of data in the system, and it officially established the blockchain.
Now, for anyone who gets lost in the jargon, to understand the blockchain, don't think of a traditional bank ledger hidden away on some private corporate server. Think of a public, decentralized ledger distributed across thousands of computers globally.
Right, ensuring absolute data integrity through just total transparency.
But the most incredible detail to me about that Genesis block is what Satoshi actually hid inside it. Hard-coded directly into the data of that first block is a text string.
It's such a brilliant touch.
It is. It's a news headline from the London Times from that exact day. It reads, "Chancellor on brink of second bailout for banks."
Yeah.
That is basically a digital time capsule of rebellion. It's a permanent, unerasable middle finger to centralized banking baked right into the absolute foundation of the code.
It really is. But, a philosophical statement is one thing. A decentralized financial system needs ironclad security to survive without a central authority protecting it.
Right, because there's no bank manager to stop a bank robber.
Exactly. So that security was built on a consensus mechanism called proof of work. In simple terms, miners on the network use massive amounts of computational power to verify groups of transactions. Every single block of data is cryptographically chained to the previous one using a mathematical hash.
Okay, so I was trying to visualize this proof of work concept because on paper it sounds incredibly dense.
It can be a lot to wrap your head around.
Right. So the clearest way I could picture it is like a massive global puzzle-solving tournament. To alter the network, say, you want to fake a transaction and give yourself 1 million coins. You can't just hack a single bank server.
No, because there is no central server.
Exactly.
Yeah.
Because everyone on Earth has a synchronized copy of the ledger, cheating requires you to outsmart and outcompute more than half of the entire globe simultaneously. You would physically need 51% of the total computational power of the network to change the record.
Which is practically impossible.
It creates this impenetrable mathematical armor around the data. But wait, hang on. I have to push back here.
Sure.
If this is all just digital data floating around on a decentralized network, how do you actually own it? Like, I can right-click and copy-paste a digital photo 1 million times. Why can't I just copy and paste a Bitcoin?
That right there is the core problem Satoshi solved. It's called the double spend problem. In this architecture, ownership is proven solely by possessing a specific cryptographic private key. The network's mathematics verify that your private key matches the public address holding the funds, and it does this without ever forcing you to reveal the key itself. It functions sort of like an unforgeable digital signature.
Oh, wow.
Yeah, if you hold that string of code, you control the asset. If you don't, you don't. No bank manager can override it, and no hacker can duplicate the asset because the global ledger would instantly reject the mathematical mismatch. It made Bitcoin the very first true form of digital property.
That is just wild to think about. Building an unhackable, decentralized system of digital property is a massive philosophical triumph. But having mathematical perfection locked in a digital vault doesn't actually mean anything if you can't buy a sandwich with it.
Right, it's just code until someone uses it.
Exactly. For a currency to survive, it requires a proof of concept in the physical world.
Someone had to actually cross the barrier from the digital realm to the physical realm and exchange this experimental code for tangible goods.
Which finally happened on May 22nd, 2010. It is now legendary in the tech world. They call it Bitcoin Pizza Day.
Such a great story.
It really is. A programmer named Laszlo Hanyecz posts on a forum offering 10,000 BTC to anyone who will order him 2 Papa John's pizzas. And someone actually takes him up on it.
Yep, the transaction clears.
It is the first documented commercial purchase using the network. He proved the asset held real-world purchasing power. 2 hot pizzas delivered to a door in Florida, paid for with decentralized internet money.
And the market completely recognized the gravity of that proof of concept. The valuation began to climb, and it crossed $1,000 per coin by 2013. But as global attention surged, the network slammed into a severe structural limitation.
Right, the scaling wall.
Yeah. The protocol had a hard-coded 1 megabyte block size limit. And because a new block is only mined roughly every 10 minutes, that 1 megabyte limit meant the entire global network could only process about 3 to 7 transactions per second.
Wait, I have to ask about this. If Satoshi was this visionary architect trying to replace the massive high-speed global financial system, why build it with a tiny 1 megabyte bottleneck?
It seems counterintuitive, right?
Totally. That is literally like building a sprawling, state-of-the-art supermarket, expecting millions of daily customers, and installing exactly 1 checkout lane.
What's fascinating here is that the bottleneck was an intentional defense mechanism. It's rooted in what we call the blockchain trilemma. You constantly have to balance 3 things: security, scalability, and decentralization.
Okay, so you can't have all 3 perfectly.
Exactly. The early priority was absolute decentralization. A small 1 megabyte block size meant that literally anybody with a cheap, standard laptop could run a node, download the whole blockchain, and verify the ledger.
Ah, I see.
Yeah, if Satoshi had made the blocks 1 gigabyte to allow for massive speed, the data load would be so heavy that only giant corporations with massive server farms could participate.
Which would instantly centralize the network.
You got it. It would
Yeah.
destroy the very thing that made it revolutionary in the first place.
Well, that structural reality sparked a massive, historically heated civil war within the developer community. Because if the main blockchain was way too slow and eventually way too expensive in transaction fees for everyday coffee purchases, it was going to fail as a currency.
Right, people wouldn't use it.
It would just become this digital gold sitting in a vault somewhere. To survive as a functional medium of exchange, the underlying engine had to be upgraded.
The ecosystem had to evolve.
Mhm.
And between 2017 and 2021, the community deployed 2 critical engineering solutions to scale the network, and they did it without sacrificing the decentralized base layer.
Right. First, there was an upgrade called SegWit, or segregated witness. From the technical data in our sources, this was a brilliant piece of software optimization.
It really was an elegant fix.
Yeah, because every transaction includes a digital signature, the witness data proving you authorized it. And that signature takes up a lot of data space. SegWit simply separated that signature data from the main transaction data. It essentially packed the suitcases much more efficiently so you could fit way more transactions into that strict 1 megabyte block.
Exactly. But the real game changer was the Lightning Network.
Mhm.
This was a layer 2 solution.
Okay, here's where it gets really interesting. I was trying to come up with a good way to explain layer 2, and the best thing I could think of is imagining you walk into a crowded bar on a Friday night.
Okay, I like this. Walk me through it.
You want to order 5 different drinks over the course of the evening, right?
Sure.
Now, if you hand the bartender your credit card to swipe for every single drink, you are paying a processing fee every time, waiting for authorization, and clogging up the line for everyone else.
Which is incredibly inefficient.
Exactly. That is like transacting on the main layer of the blockchain. Instead, you open a bar tab. You keep a running tally off-chain between you and the bartender. You can order instantly back and forth all night. Then, at the very end of the night, you settle the final bill and swipe your card on the main network just once.
That is a perfect analogy. The Lightning Network digitizes that exact mechanism. Two users open a payment channel, they lock in some initial funds on the main blockchain, and from then on, they can send thousands of microtransactions back and forth to each other almost instantly.
And with practically zero fees. Right.
Yes, because they're just updating an off-chain ledger between themselves. They only broadcast the final balance to the main, slow, secure blockchain when they finally close the channel. By moving everyday commerce off the main chain, the network's capacity exploded from 7 transactions a second to potentially millions.
And that technological leap is what gave a sovereign nation the confidence to actually step into the arena. I mean, in 2021, El Salvador made history by adopting Bitcoin as legal tender.
Which was just a massive paradigm shift.
Completely. And the Lightning Network was the underlying infrastructure that proved the technology could actually scale to handle the daily economic activity of millions of citizens buying groceries, paying for haircuts, and settling debts.
Right. But a sovereign nation adopting a currency born from cyberpunk forums fundamentally altered the global financial posture. The Wild West era of unregulated experimental crypto was over.
They couldn't ignore it anymore.
No. If this technology was going to integrate into the daily lives of average citizens and corporate supply chains globally, traditional governments were absolutely going to demand stringent oversight.
Which takes us right into the 2022 to 2026 timeframe. The market was basically forced to mature. In the European Union, the critical turning point was the implementation of the MiCA regulation, the Markets in Crypto Assets framework.
Yes, MiCA was a huge milestone.
Because before MiCA, a crypto business operated in this perilous gray zone. Banks might arbitrarily shut down their accounts, and users had zero protection if an exchange collapsed. MiCA replaced that chaos with the unified licensing regime across the EU. It established strict rules regarding how much reserve capital an exchange must hold, and it implemented real consumer protection standards.
Mandating liability for lost funds, yeah.
But looking at this critically, I have to ask, doesn't writing a massive government rulebook entirely defeat the purpose of Satoshi's 2008 anti-state, anti-bank manifesto? I mean, the whole point was to build a system outside the traditional financial rules, and now we are celebrating the traditional financial system writing the rules for it.
If we connect this to the bigger picture, it reveals the ultimate paradox of mass adoption. To achieve Satoshi's dream of a peer-to-peer electronic cash system used by the average citizen, the ecosystem had to offer legal safety.
Because normal people aren't going to risk their life savings on an unregulated experiment.
Exactly. And a multinational corporation is never going to integrate a decentralized payment rail if their compliance department flags it as an unregulated liability. Comprehensive regulation like MiCA acts as the necessary bridge between hardcore anarchist philosophy and mainstream utility. It banishes the shadow banking elements of the industry and replaces them with verifiable trust.
It's a pragmatic compromise for the sake of global survival.
Well said.
But even with legal frameworks ensuring institutional safety, and even with the Lightning Network ensuring instant transaction speeds, one massive glaring problem remained for the regular person on the street: price volatility.
Oh, absolutely.
You cannot run an economy or even buy a cup of coffee if the currency's purchasing power might drop 10% while you are literally standing in line waiting to pay.
Volatility was the final stubborn barrier to everyday utility. You just cannot use a volatile asset as a reliable unit of account. So the solution dominating the landscape today in 2026 is a fascinating hybrid model.
Right.
It's taking the borderless efficiency of blockchain technology and fusing it with the stability of traditional fiat money.
The era of the stablecoin. According to our notes, the vast majority of modern crypto transactions today don't use volatile assets like Bitcoin. They use stablecoins like USDT or USDC.
Yes, and to understand how a stablecoin functions, you really have to look at the reserve mechanism. For every digital USDP token issued on the blockchain, the issuing company holds one actual US dollar, or an equivalent ultra-safe asset like a treasury bill, in a regulated bank vault.
Okay, so it's backed one-to-one.
Exactly. That reserve is audited and verifiable. So the digital token maintains a cryptographically enforced one-to-one peg with the fiat currency. You get the 247 borderless, instantaneous payment rails of the blockchain, entirely stripped of the roller coaster price swings of the crypto markets.
And this brings us to the user experience today, which is almost shockingly mundane. Modern fintech companies have successfully taken all the complex cryptography we just discussed and hidden it completely behind slick, intuitive interfaces.
You don't even see the code anymore.
No, the apps look and feel exactly like the traditional banking apps you already use. Our sources point to platforms like Trustee Plus as a prime example of this invisible architecture.
Yeah, look at the mechanics of a transaction on a platform like Trustee Plus. A user might hold their long-term savings in a volatile asset like Bitcoin within the app. But when they want to spend it, they don't have to wait 10 minutes for a block to confirm.
Right.
In 2 taps, they swap a portion of that Bitcoin into a stablecoin. And the app is deeply integrated with traditional payment rails like Apple Pay and Google Pay. So the user holds their phone near a standard terminal, the NFC chip communicates, and the payment clears instantly.
So what does this all mean for the end user? It basically means these modern apps are functioning as real-time, high-speed digital translators. You are speaking the language of decentralized blockchain. The merchant's cash register only speaks the language of traditional dollars or euros, and the app translates between the two in milliseconds under the hood.
That's a great way to put it.
The user is entirely shielded from the complexity. You just see a seamless swipe.
It is an incredible engineering feat. It completely fulfills the original vision of a frictionless, peer-to-peer electronic cash system. But the execution is wildly unexpected. The heavy-duty cryptography, the decentralized ledger verification, the hashing power, that is all still churning in the background. But the friction has been engineered completely out of the human experience.
But there is a catch. Because the technology has become so user-friendly, so entirely invisible to the person tapping their phone, it creates a new kind of vulnerability. It is dangerously easy for users to forget that underneath that polished Apple Pay interface, the uncompromising, unforgiving rules of cryptography still apply to them.
The cyberpunk tenets of 2008 remain fully intact. The seamless user interface hasn't erased the core responsibilities of a decentralized system. It has merely masked them.
Let's run through those responsibilities because they are vital. First, account security. If you are operating in this space, mandatory use of two-factor authentication is non-negotiable. Second, self-custody. If you choose to hold your own crypto outside of an exchange, you hold a seed phrase, the master password to your private keys. You are your own bank vault. Third, compliance. A digital borderless currency does not make local tax laws disappear. You have to adhere to tax regulations and track your capital gains.
You can't just hide from the IRS.
Right. And finally, due diligence. You have to verify the services you interact with, ensuring they comply with frameworks like MiCA. The friction here is pretty intense. We want the mindless convenience of Apple Pay, where we just tap and go. But simultaneously, we have to act with the vigilance of our own personal bank security guards.
Because the stakes are so high.
Yeah, because if you write down your seed phrase on a piece of paper and lose it, there is no 1-800 customer service number to call. There is no branch manager who can verify your identity, reset your password, and hand you your money back. The mathematics dictate that the money is simply gone forever.
This raises an important question, though. It asks you to reflect on the trade-off. What is the actual price of true financial sovereignty? Decentralization fundamentally removes the middleman. That is brilliant because it removes the extortionate fees and the gatekeepers who can arbitrarily freeze your funds.
Right.
But removing the middleman also removes the safety net that the middleman historically provides. The ultimate trade-off built into this technology is between absolute control over your wealth and absolute personal responsibility for it.
It is a heavy trade-off, but clearly, given the scale of the global infrastructure today, millions of people are making that exact calculation every single day. Let's synthesize the journey we've covered today.
Let's do it.
We started with an angry, anti-establishment message hidden inside a cryptographic block during the darkest days of the 2008 financial meltdown. We traced the path to a programmer buying 2 pizzas just to prove the code had physical value. We watched a community tear itself apart over a 1 megabyte bottleneck, resulting in the brilliant Layer 2 engineering of the Lightning Network. We saw a sovereign nation adopt it, forcing traditional governments to build regulatory bridges like MiCA. And finally, we arrived at the seamless, stablecoin-powered invisible tap on your phone in 2026.
Every single time you use one of these modern financial applications, you are leveraging the outcome of an 18-year push and pull. You are interacting with the continuous ideological and technological friction between cypherpunk rebels demanding freedom and traditional financial institutions demanding security. The app sitting in your hand right now is the incredibly sophisticated truth they eventually reached.
And that brings me to a final thought I want to leave you with today. Something to really mull over the next time you are standing in line for a coffee and you tap your phone to pay.